Here we have some sad news to share. Charlie Munger, Berkshire Hathaway's vice chairman and Warren Buffett's longtime business partner and close friend, has died at the age of 99, just a little more than a month shy of his 100th birthday.
The investment community paused for a day after the passing of Charlie Munger, Warren Buffett's long-term sidekick, on Wednesday this week. Munger has had a transformative impact on Berkshire Hathaway, helping Buffett in particular transition from a cigarette-butt approach, moving away from cheap, troubled companies.
He made a lot of money buying thinly traded securities that were incredibly cheap statistically. And with small amounts of money, which is what he's working with, he could find enough of those to earn pretty high returns on capital.
Munger was regularly the sounding board for Buffett and was labeled as an abominable no-man, keeping Buffett away from more stupid purchases. Munger also had serious influence on a number of investments, including the $25 million takeover of See's Candies in 1972, the $6 billion purchase of Israeli metals Iskar, and the purchase of shares in BYD, a Chinese car manufacturer.
The first real business we bought that way was See's Candy. I mean, it was really an outstanding business. And I still had enough elements from my past that I really didn't want to pay the last few $1 million. And
Few million? You didn't want to pay the last $25,000.
Yeah. And Charlie reminded me that I was slipping back into the Stone Age again and got me to move.
Even though Berkshire won't be the same without Munger and Buffett, succession planning is absolutely pivotal for a business like Berkshire Hathaway, as we edge closer to an era with different leadership for the investment giant. Berkshire Hathaway was once a struggling textiles firm before Buffett took over in 1965. Buffett made the decision to shift the business towards becoming an investment holdings company by acquiring National Indemnity Insurance as well as stakes in the Washington Post. Charlie Munger joined him in the late 1970s, which is when the pair changed direction, focusing on good businesses with long-term value rather than cheap businesses.
I've been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap. And that I was taught that, we'll say in 1949 or 50, it made a big impression on me. So I went around looking for what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts and you find this, on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. It's disgusting, you throw it away, but it's free. It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price. But in those days, I was buying cheap stocks.
For years, investors have been anticipating a change in leadership, and many thought that David Sokol, who joined as part of the Mid-American Energy acquisition, would be heir apparent. That was until his resignation in 2011 after controversy with Lubrizol. So what next? That brings us onto the new leaders for Berkshire Hathaway. Who are they and how will the business change? The new leaders of Berkshire Hathaway will be Greg Abel and Ajit Jain, 61 and 72 years old respectively. The pair have admitted they aren't as close as Buffett and Munger, but do regularly chat around their respective businesses. The investment team is also managed by Todd Coombs and Ted Weschler, brought in 2012 to work closely with Warren Buffett, who'd been running things alone until that point. Berkshire is in a strong position, with around $157 billion in cash on the balance sheet. And if Buffett were to kick the bucket, there's unlikely to be a large drop in the share price. And if you did see one, Berkshire would no doubt use it as an opportunity to buy up their own stock.
When the opportunity presents itself, we'll want to be an active repurchaser of Berkshire shares. We think it's a great outcome for Berkshire shareholders to own a larger piece of each of our operating businesses and the portfolio, the equity companies, when the opportunity presents itself.
Berkshire Hathaway Vice Chairman Greg Abel has long been touted as the successor to Munger and Buffett. They originally revealed in 2021 that he would take over, and the Canadian rose through the energy business before becoming vice chair of the Berkshire non-insurance business. Munger and Buffett have hand-selected the board and the investment team to make sure that the style of investing doesn't change as the business moves forward without its long-standing leaders. A long-time employee, the hope is that Abel will keep the same culture at Berkshire, with Munger calling him a sensational business leader, both as a thinker and a doer. It brings us onto the question of why Greg Abel. Clearly, it's not an easy seat to fill. However, many of Berkshire's subsidiaries have heaped praise on Abel. Pat Egan, CEO of See's Candies, said Abel is the first call Buffett makes when he needs advice, and he rarely needs to make a second call. His ability to retain and process information is unlike anything I've ever seen.
The answer is Greg understands capital allocation as well as I do, and that's lucky for us. And he will make those decisions, I think, very much in the same framework as I would make them.
Berkshire's focus on management autonomy and decentralization pushes responsibility onto the business that they've invested in, which eliminates the need for layers of middle management and puts less pressure on leadership, with a continued focus of incurring minimal costs for shareholders.
Marrying somebody to change him is crazy, and I would say hiring somebody to change him is just as crazy.
Yeah.
And becoming partners with him to change him is crazy.
In spite of the devastating news of Munger's death, many had speculated whether the Berkshire share price would fall if either Munger or Buffett passed away. And on Wednesday night, they got their answer, down 0.5%, almost nothing. The company had primed itself for this moment for almost a decade, with Buffett joking in 2017, "If I die tonight, I think the stock would go up tomorrow." Weirdly, this isn't the first time that Berkshire has been impacted by morbid news, as several of their board of directors have already passed, including Walter Scott, Thomas Murphy, and David Gottesman. With new leadership brings a new future, but it also brings new challenges. Many have noted that Buffett and Munger were very open and honest about their investment approach, particularly around what they did and didn't know. But Coombs and Weskler's approach still remains somewhat of a mystery. Bill Smead, a large Berkshire shareholder and the CIO of Smead Capital Management, has stated that the lack of detail around the performance and approach of Coombs and Weskler has been a frustration, and hopefully they will fill the void left by Munger. With diversity, equity and inclusion key in the investment world nowadays, many have also noted that Berkshire may soon feel more pressure to create a more diverse board. Another challenge will be the loss of legacy, with the yearly Berkshire Conference likely to attract lower numbers once the key men are no longer present. To conclude, Berkshire Hathaway could not have been built to its present status without Charlie's inspiration, wisdom, and participation, said Buffett in a statement. It leaves investors awaiting a changing of the guards to see how Greg Abel, Ajit Jain, and the investment team alter the approach, or don't. As Warren Buffett wrote, Berkshire's advantage is that it has been built to last.
Now, our vision for Berkshire is exactly what we said today. We want it to be a company that is owned by its shareholders and behaves in a way that society is happy that it exists and not unhappy. And we will have unlimited capital. We'll get lots of talent. And we've got a base that can't be beat.